Okay. So today we'll be continuing Chapter 19, Cost, Volume, Profit Analysis. Last week we briefly went over simply just one section. So who remembers just a little bit what we covered Chapter 19 in the beginning? Variable costs, okay. What else? You have variable costs, there's fixed cost, and mix. So which one goes up and down with sales? Variable costs for sure, and mixed costs, after a certain threshold, it also goes up, right? Remember, mixed cost has a portion of fixed and then a portion of variable costs mixed together. So we also introduced to you high-low method. Remember how to do budgeting for future seasons mixed cost. We talked about a utility cost example. Also, cell phone bill is also one of the example of mixed cost. Remember, you have a fixed data plan every single month, but then if you cross over that fixed plan, if you go over, let's say, 700 minutes or 3 GBs data plans, then you have to pay according to how much you actually used over that fixed plan. Okay, so we introduced you in Chapter 19 3 different types of costs: variable cost, fixed cost, mixed cost. But remember, we're still talking about the same cost pool as we discussed in the first 3 chapters. It's just now we're understanding cost in a different angle. We're not looking at its physical characteristics, how we actually use it in the production cycle, but we want to know how stable it is. Does it goes up as sales activities goes up? So variable cost, mixed cost are examples that the cost volume, the cost quantity actually changes as we use certain machines, certain equipments, or as we make sales to customers. As opposed to this idea, fixed cost, remember, regardless of sales activities, it stays the same. So fixed cost, we had in the chart where there's different number of events and the costs that incurred accumulated. Remember, the cost for fixed is always a straight line, right? Okay, so today we'll be continuing these different categories of costs. We'll be going over detailed analysis process on how to link this cost information to sales, volume, and profits. So you'll be introduced different ratios, different equations. The goal really is to understand the relationship between costs and different volumes of sales. How is cost accumulated based on this basic concept? And then what is the profit that the company at the end is eventually getting? Right, so we'll be understanding CVP analysis in more details. So what CVP stands for: cost, volume, and profit. So first 3 chapters we talked a lot about how to assign costs to different jobs based on the labor used, material used, overhead. Those were really just focusing on the cost side, not that much on the sales, not that much on profit. Okay, so now we're kind of pulling all these information towards the sales and profit side, understanding how the cost information relates to sales volume, how it relates to the profit that company at the end is receiving. Because remember, profit is the most important thing that companies generate, and then for them to keep the business viable. So you can't just make profits and not being able to sell to customer, or not being able to generate profit, kept on getting losses. They have to get profit at the end. So this analysis will help us understand these important questions here. For example, how much we actually need to sell in units or in dollars in order to break even. Now, what is break even? To be able to cover expenses. Exactly. You will have sales revenue to a certain level that is just able to cover expenses. So if you go beyond the break-even point, you'll be getting profit. If it's lower than break-even point, then you'll have operating losses. Okay, so the first question we want to understand here in this chapter is, what is the break-even units in units and in sales dollars? So how do we understand this based on the cost information given to you in each and every problem? Okay, now, before we go into CVP analysis, you'll be introduced different ratios, equations. The basic assumption here, wanted to point out here, is that this is built upon these 2 bullet points. So in the industry, we assume if you use CVP analysis, cost can at least be classified into fixed cost and variable cost. It has to be either or, one of them. So we're kind of omitting mixed cost here for simplicity purposes. Okay? So mixed cost, remember that for different types of utility or cell phone bill, you may have a different fixed portion, different variable slope. So this portion is a little bit more complicated to do this analysis in order to just put it into one simple equation to calculate break-even points. So for simplicity purpose, CVP analysis usually omits the mixed cost portion. But remember, for the most part in the industry, cost is either these two categories. That's the majority portion. Mixed cost relatively is a smaller category, and some of the business may not even have mixed cost portion. Okay? Just so you know that this portion is omitted for simplicity purposes. Later on, we'll be just focusing on fixed and variable portion. So in reality, this CVP analysis really is more of an approximate estimation of approximately where's the break-even point in units, sales, where's the break-even in dollars. It's not really the exact number, unless the business doesn't have mixed cost category. Okay? So again, what is break-even? The sales volume that is just able to cover the operating expenses. Okay, so if you have $1,000 of sales generated and the cost, adding variable costs and fixed costs together also totals up to $1,000, then you know $1,000 is the sales revenue that you have to generate in order to at least not have loss. To have zero operating income, then if you go over this $1,000 sales revenue, your company will start getting profit. Okay, so sales above break-even result in a profit. That's the kind of the threshold for the business. They have to know that at least they have to make this dollar amount of sales in order to start getting profit. And this is also the threshold. If you go below it, you'll be getting operating losses. Okay, so the next few slides we'll be learning two different approaches to calculate break-even point. We'll be calculating break-even point in the events or in the units of products you sell, and also break-even in actual sales dollars, revenue. And the first approach here, income statement approach, if you recall income statement, what's the very last line you get? Net income, okay? And how do we get net income? Revenue minus expenses, that's the general idea. Okay, so income statement approach is going back to the idea of the format of income statement. You use total of all the sales revenue minus total costs. That will give you operating income. This is the general equation. Then we'll be plugging in more detail, classifying the total cost portion into fixed and variable costs. Okay, and then the next approach here after introducing income statement will be substituting certain terms into contribution margin. That will be the contribution margin approach, but both of these approaches we're trying to get to what's the break-even point in units and in sales dollars. Okay, let's take a look at income statement approach. So from this equation here, can you tell me what's the sales revenue that this company is getting? Again, assuming it's a DJ service company, they're trying to provide basically music or service related to weddings or parties, events, and each and every event that they give customers, they're able to charge customers $200. That's the sales revenue part. Okay, but what about the cost portion? What's the fixed cost that the company is generating for the season? $12,000. Okay, and remember this is the fixed portion, so it stays the same regardless of the events that is held in the business. And what about variable costs? Variable cost here we see $80, which means for every DJ service event they provide to customer, they will generate $80 of cost, for example, equipment rental or other machines rental for their event to be able to provide to customers. So this $80 is not a fixed portion, it's a variable cost, which means if they have one event requested from customer, they have $80 incurred. If they have two, $160. 3, $240. Okay? So we have two types of costs. You know, fixed cost is $12,000. Variable cost is $80 per event, and you're generating revenue $200 per event. So if I ask you, how are we able to determine what's the number of events that we need to hold in the business in order to have zero operating income? Remember the break-even point. How are you going to solve this problem? Does this seem right? So the X portion is the events. Here we say units. It could be also used for different problems, selling machines, selling different types of equipment or different products. And for this particular problem in the book, they are providing events, services. Okay? So the X is the number of events. For each and every customer you provide services to, you generate $200. For each event, you have, $80 of variable cost here. And then regardless of the events, you have fixed cost, $12,000. Yes, we only have X right now. So how would you find out the X, which is the number of events? Because we want to know how many events we need to provide to customer in order to cover these fixed cost and generate zero operating income at the end. So we find out the X by subtracting variable cost 80X from the sales revenue we're generating, 120X minus the fixed cost portion, and again we want to find break even, so we set the operating income at zero. Break-even point determines that what's the threshold, and if you go above it, you're getting profit. If you go below it, you're getting loss. So we set it at zero because we want to know what is this, X portion. Okay, so how many events should we get in order to cover? We should be getting 100 events. Okay, so this equation up to here, and then you add both sides by $12,000. Simply move this fixed cost to the other side of the equation. So you can solve X. The break-even events is 100, which means this company has to provide to at least 100 customers with DJ services. You have to have 100 services in a year to cover fixed cost portion and variable costs, both of them. Okay, so if they provide only 80 events, then they will not be covering the fixed cost and variable costs because 200 multiply 80 gives you $16,000. Variable cost will give you $6,400 minus fixed cost. How would this add up to? This will give you minus $2,400. You will have an operating loss if you only have 80 events. So the opposite example, if you have 120, if you plug in the equation, you'll find yourself having an operating income above zero. This is the income statement approach, really just guiding you through the idea of revenue minus expenses equals the profit. Okay, and we're setting the profit at zero because we want to find out what's the number of events that we need to provide to customers in order to break even. Okay. Now the next approach here, if you get the idea of income statement approach, what contribution margin approach really is just substituting a portion of the information that you just learned earlier. Just we call the differences between sales revenue and variable costs. We call that differences portion contribution margin. So if you go back to this equation earlier, can you tell me which portion looks like contribution margin? The differences between sales and variable costs. So really is this first part of the equation. Okay, differences between sales revenue and variable cost, we call it contribution margin. Why? Because this is really the portion, the difference is, the larger this is, the more your company is able to cover this fixed portion. So this portion contributes to covering fixed costs and contributes to provide profit for a business. Remember, fixed cost is always there. Regardless of the number of events, you have to cover this $12,000. That relates to perhaps full-time employees' salary, relates to straight-line depreciation of assets of machines. This is a portion that no matter what you have to cover. You're really generating this portion contribution margin in order to cover this, to get to profit. Okay, so we call the differences between retail price and variable costs contribution margin, which is the $120 for each and every event your company held. Okay, so this portion is the same as that equation, it's just that now we're substituting that differences, call it a new name, and then again we minus fixed cost equals operating income, and we want to set this at 0 to figure out, again, what is the number of events, the X here. Okay, it's just two different approaches. And this chapter particularly will be focusing on contribution margin approach, also for later analysis. Okay, so income statement approach really is just guiding you to understand what this is about. We're just substituting the first portion, give it a new name, contribution margin, because it contributes to covering the fixed cost incurred in the business and contributes to later on getting profit. Okay, so meaning that the more number of events the company is able to provide to customers, this portion grows larger and larger, large enough to cover this, then your company is getting profit. Okay, so let's take a look at the equation again. Same equation, but now we substitute the first portion, put a bracket around it, and we call it contribution margin per unit. So remember earlier we had 200 multiply units, 80 multiply units sold, minus $12,000. Now the first bracket here represents 120 multiply units sold, then minus $12,000. Okay? So what does this lead us to? It leads us to a shortcut equation listed here. Okay, so if you take a look at this, if you're given each and every problem, and the problem asks you to calculate break-even units, if you memorize this, you can simply just plug in fixed costs, plug in 0, break-even, operating income representing a 0 income, then the contribution margin per unit divided by contribution margin per unit, you should be able to directly get the X here. So instead of going through the equation from the first line, second, third, fourth, then get the X, you can directly get the X, the number of events to break even, by using this equation, this shortcut formula here. Okay, so how did we get to this? We simply just rearranged that equation. Okay, if you look at the upper part here, remember we start from revenue minus the two different costs. We call the first portion contribution margin. We still have to minus fixed costs, but we rearrange fixed costs to the right-hand side of the equation. And then just divide both sides by contribution margin. So the left side of the equation is just left with the units. The right side, you have this. Okay, so remember earlier we had this problem? If I want to represent this in the formula, how would I write this down? Fixed cost, $12,000. What about operating income? 0, because we want to calculate break-even point. Then divided by 120. So this portion we get 120 from sales minus variable cost 80. So we should directly be able to get 100. Okay, so this formula here is useful to calculate break-even units. When you look at a problem, just plug in the numbers if you memorize this. So to understand this better, really we're using contribution margin, which is the $120 you generate from each and every event to divide fixed costs. So the larger this portion is, the more you're able to cover fixed costs, and you want to know how many units you should be getting in order to cover that full $12,000. So you use the 120 to divide $12,000 to get the 100 events break-even point. Okay, let's work on an example. Okay, before we do that, this is really just covering what I just wrote here on the whiteboard. The 100 events, and if you want to double check your answer, just plug it back to all the information you had earlier, 200 events, multiply $200 per event, you're getting sales revenue 20,000. And then for 100 events, you have variable cost 80, so you got $8,000 variable costs. Remember, fixed costs, don't forget this. So at the end, we get the operating income 0, which tells us that we did calculate this 100 events correctly. So this is just double checking the answer. All right, let's work on an example here. So the Story Park company competes with Splash World by providing a variety of rides. Story sells tickets at $50 per person as one-day entrance fee. So that's the sales revenue part per person. Variable cost per person is $10. Fixed portion is $240,000. You try to figure out the number of tickets this company needs to sell in order to break even, and then double check your answer by plugging it back in all the information. Got the answer? 6,000. Sounds right. And how did you get it? Okay. 0. Subtract the 10 from the sales revenue per person, 50. So fixed costs, thank you. Fixed costs $240,000 divided by variable cost per ticket you sell to customer, which is 40. This will give us 6,000 units. So if we match it with this problem, that will be 6,000 persons tickets that you need to sell in order to cover the fixed portion, $240,000, and the variable cost per person, $10. Okay, now how do we double check whether this answer is correct or not? You want to double check whether this 6,000 events is correct or not. Go from the top to bottom, sales revenue. 6,000 tickets will give us how much of sales revenue? We have to multiply by per tickets revenue 50, so we should be able to get 30 is 300,000, right? 300,000 sales revenue, and then we minus variable cost $10 per person of 6,000, so variable cost is 60,000. Then fixed cost, 240. Okay, just double checking your answer whether the 6,000 events is really the break-even point. So just plug it back in, all the sales revenue information, variable cost, fixed cost, and see if you can get operating income 0 at the end. Now, we talked about break-even units. We double-check it by just plugging it back into all the information we have from the problem. So we know that the break-even sales is $300,000 here. And on the next few slides, we'll be directly calculating the break-even sales. So instead of understanding it by how many units, managers may also ask the question, what is the break-even sales? And how would you be able to quickly get to this number? There's also a few shortcuts to use. Okay, so we have been focusing on units here in the first part, and now we're focusing on representing it in dollars, break-even dollars. Okay, so how do we get to that? We still use contribution margin information. Remember the 120 earlier? For every event you sell to customer, you're able to generate contribution margin $120 per event. So that 120 we use that number divided by sales revenue, 200. This gives us contribution margin ratio, the upper formula there. So we understand this by, let's say it's points. How much is this? Somebody give me the number. It's 0.6, right? Okay, thank you. So this 0.6 means for every dollar of sales generated from customers, we're getting 60 cents of contribution margin. For $2, we're getting 1.2. $3, 1.8. $4, 2.4. Okay, so this contribution margin ratio, we use that to divide fixed costs. So earlier we had fixed cost, $12,000. This will give us directly the dollar amount that we need to make in order to break even, sales in dollars. Okay, so not in events, but in dollars. Remember earlier we had 100, should be 200, 20,000. So the 100 events we got earlier, each and every event we generate sales revenue $200. The break-even sales should be 200,000. And now we're getting this by these two formulas. First one, really, we're just using contribution margin divided by sales revenue. So that gives us per dollar of sales how much we're getting as contribution margin. So if contribution margin is 0.6, that means the 0.4 is the fixed cost portion if we're setting it as the break-even point. Okay, so this 0.6, the larger this number is, the more we're able to cover the fixed cost, and we want to know how many 0.6 we need to have in order to cover this $12,000. So this at the end will give us the sales in dollars, the break-even sale that we need to make in order to not have loss. So just another way to look at a problem, if not in the break-even units. If the problem directly asks you what is the break-even in sales dollars, and you calculate contribution margin, use it to divide fixed cost, you should be able to directly get this dollar amount. So this is not in units, this is directly the sales volume, sales value. Okay, let's see what the numbers here. Fixed cost divided by contribution margin ratio. Again, the ratio is per dollar of sales, how much is the contribution margin we're generating, which is 0.6, and then use the 0.6 to divide fixed cost. So we want to know how many times fixed cost is over the ratio to get this 20,000 sales dollars. Because for every dollar, we're getting 0.6. Every dollar, we're getting 0.6. So we want to know how many dollars we're trying to get as sales revenue in order to cover the $12,000. Okay, I know it's a lot of numbers and formulas, so let's just go from top to bottom again. First part we covered here, contribution margin. Again, the differences between revenue and variable costs. So this is really the portion the company is getting as sales volume increases. Of course, your variable cost also increases, but your contribution margin also accumulates. If sales is 200, variable cost is 80. For every event you're able to hold and provide to customer, you're generating 120. So the more number of events happens, the more contribution margin you're generating, and this contributes to covering fixed cost, $12,000. Okay, so the next question here is we want to know what is the break-even units the company needs to have in order to cover this $12,000. So we calculate contribution margin 120 and use this to divide fixed cost. So you should be able to calculate your break-even units, 100 events for the problem in the textbook. Okay, now another way to look at this problem, if we're not calculating units, but we're calculating sales, break-even sales in dollars, then we get contribution margin ratio first, which is just the relationship between sales and contribution margin. Remember, this part is 120, sales is 200. So for every dollar of sales, we're generating 60 cents of contribution margin. We use that 60 cents to divide fixed cost, again, $12,000, to figure out break-even sales, $200,000. So all of these, the concept really is just getting to break-even level. It's just that we're understanding it either in break-even units or directly in sales dollars. If you get break-even units, then you still have to multiply break-even units by 200 in order to get to this $20,000. So this is a shortcut to get to sales in dollars. This is a shortcut to get to the break-even units. Exactly, 40 over 50, this is the CMR, contribution margin ratio, and then you got it as 0.8, right? 0.8, this is the ratio, and use that to divide the fixed cost, which is 240, to get the break-even sales, yes. Okay, so you pretty much just covered this problem, but let's just do it again. Okay, so for the people that wasn't able to follow this, try to figure out contribution margin ratio for this problem again, that we did earlier, and then use that to determine sales revenue to break even. So get the ratio first, and then the sales revenue. So for this problem, to calculate contribution margin ratio, and this ratio is the relationship between sales revenue and contribution margin. We want to know for every dollar of sales revenue, what's the portion that a company is generating in order to cover fixed cost. So sales revenue for each and every person's ticket worth $50, and contribution margin for each and every person's ticket is how much? Would be 40. Right, sales revenue minus variable costs, so you have 40 over 50, which gives you 0.8, meaning per dollar of sales revenue, you're generating 80 cents of contribution margin. Contributes to covering profit, covering fixed costs to generate profit. Okay, so then the next question, once you have this ratio, is how many 0.8 do we need to get in order to cover the fixed cost to $40,000? So we want to know how many 0.8 we need to get to cover this. So we use this number to divide and divide it by 0.8. So we want to know how many times the fixed cost is over the contribution margin ratio to understand what's the sales revenue that we need to get. Will be 300,000, yes. Okay. So depending on the problems you see in the chapter, the homework, or different questions, if they ask you, the problem asks you break-even sales in units, you can go to this shortcut formula. If they ask you what is the sales in dollars, then it's better to calculate contribution margin ratio. It's quicker to get to the break-even sales in dollars. So rather than going through all this calculated units and then multiply sales revenue, you can just directly calculate the ratio and then divide it by fixed costs to get the sales in dollars. Okay, but really these information are the same, just in different angles. They're all relating to break-even points. It's either in the units, the events that companies need to provide, or the sales revenue that they need to generate. Okay, any questions so far? Or too easy? Okay, there's no questions. You know how to do all the above four equations and formulas that we just went over. Next, we're adding in more concepts. So we just talked about break-even point, but is that enough? Is break-even point enough for a business? No, that's not enough. So that's just the minimum requirement to not have loss and start getting profit. So the next analysis we want to do is, of course, management level would be interested in knowing how to set a target profit plan and then how that relates to sales in units and sales revenue that they need to generate in order to meet that target profit. Okay, so later analysis, So now what's the only difference between what we're trying to discuss here and earlier is that earlier we set the operating income as 0. That's the break-even point. Now, if the problem tells you the manager has a plan to get 1,000 operating income, or 10,000, or 100,000, then what is the contribution margin that we're getting in order to receive the target sales? Or what is the target sales we want to get if we have a fixed contribution margin ratio already? Okay, so now we're not using 0 anymore, because if we set a target plan, target profit, then we'll be plugging in operating income dollar amount here. So it will not be 0 anymore. So we only use 0 when we're getting break-even point units, break-even point sales. Later on, if there's target income, make sure to plug in target income as well. Because if there's a target plan, it's not break-even, then you want to know how many units you need to sell in order to cover both fixed costs and also generate the particular plan of profit. Okay, now let's take a look at some of the data points here. If this is the information given to you for the past year, okay, the information for the past few years, what is the break-even point here if you just look at this table? Can you tell me? In units or in sales? In units, that will be the 100 events is the break-even units, and then for every event you're generating $200 for sales. So multiply those two numbers, you can get sales revenue 20,000. So this income 0 is the break-even point. If you are generating events, having only 50 low season, then you're not getting profit. If you're going above it, you're getting 150 events, 200. This is the income you're generating. Okay, now the middle columns here, this is the total cost incurred, which includes both fixed and variable. So remember, this also goes back to that example we did earlier. Fixed cost is still 20,000, and the variable cost is 80 per event. So you need to multiply whichever events that happen, add them together, gives you the total cost. Okay, so this particular break-even point, remember we did 100 events, gives us 80,000. 8,000 fixed cost, a variable cost, and plus fixed cost together, the total cost is 20,000. Okay, so those equations there, you're able to get, if you plug in a data point, plug in the number of events, or if you plug in the cost information, you should be able to get each and every season's potential sales revenue, potential cost information. But what if we wanted to do analysis and look at it in various different levels of events and various different sales revenue? And it will be very useful for us to plot down all the data points that you're able to get from the equation. Remember, all we did earlier was just specific points. When sales revenue is 50 for each person, what if we change it to 40? Or what if we raise the cost later on? So this chart here gives you more comprehensive information on different levels of events, and then what's the sales revenue generated, also what's the cost incurred. So the first step to draw this chart or to understand this chart, we usually start from revenue. Okay, the number one step here, choose a sales volume, plot the point for total sales at that volume. So if we choose 100, let's say, sales revenue is 20,000. If we go back to that chart, just plug in 100 events and find the point 20,000. Put a dot there, link it to 0. Now why are we linking it to 0? Because when there's no event sold, we're not getting any revenue. Okay, so make sure you understand which lines links to 0. There is a particular line doesn't link to 0, which is the fixed cost portion, right? Fixed cost is the green line, which is the next one we're covering here. Regardless of the events that occurs, you always have $12,000 that the company needs to cover. Okay, so the first line you're drawing here is sales revenue. Just pick whichever data points. You can also pick 200. Revenue is 40,000, so if you go back to this chart, 200, match it with 40,000, draw a dot over there, and then link it to 0. That will give you the red line. Green line, fixed cost, always the same, flat line, doesn't link to 0, because even if you don't have customers requesting DJ services, you still have to depreciate the assets. You still have employees' salary to cover. Now what is the blue line? Total cost, which includes both fixed and variable, which is why we are starting from where the green dot links to the y-axis, because we're also incorporating fixed cost. So the slope is what? How do we determine the slope of the blue line? Remember the slope? What is the slope? Fixed cost is here, the green line. And if this is the fixed plus variable costs, this is the blue line up there, then the slope is x-axis, and use it to divide y. And why does it have a line like this? What is it causing this line to look like that? Is it the fixed or the variable? It's the variable portion, right? And then remember earlier we talked about variable cost is $80 per event. So really this slope is 80. For every event happen, you have $80 of cost. 2 events that happens, you have 160. 3, 240, right? So this variable here, the reason why it's going up in that direction and that angle is because of the variable cost. Okay, so again, if we use the break-even point as an example, 100 events, we have total cost 20,000. Jot it down over there, 100, 20,000, and then link it to the green line. Remember the fixed cost line, because that's the total cost portion. Now, this chart, the goal for this chart is to understand break-even point and also the operating income portion. So where the sales revenue line joins with the total cost line is the point where the company has break-even units and break-even sales, which is the 100 events, because you see sales revenue for 100 events is $20,000. Sales revenue, $20,000 equals the total cost incurred for also 100 events. So meaning wherever the sales revenue equals the total cost is where the break-even point is, and also what we have been doing earlier. Okay, so in units, it's 100 events. In dollars, it's $20,000. If you go above the break-even threshold, you can see that once you go above, the red line is above the blue line, and the shaded area in green is the operating income portion. So for every event that goes beyond the break-even point, you're generating $120 contribution margin. There's 2 events that goes beyond 100, you're generating $240. 3 events, $360. 4 events, $480. So you can see that shaded area grows larger and larger. The more events you're selling, the more profit you're getting. As opposed to that, this red area, the operating losses, if it's lower than break-even threshold, then the lesser events you're able to provide to customers, the more operating losses is incurred. Okay, any questions on understanding this chart? So basically you just have to know what does the joint dot mean, how to graph this, and what does the shaded area means. Operating income, left-hand side is losses, yes. I haven't decided on the next exam, but that would be a good idea. No, I'm just kidding. Probably not. I will probably focus more on understanding the chart. Okay, like where the dot joints, yes. That could be an option, but I will save it for now. Maybe. Okay. Any more questions? Okay, this is just kind of combining what we covered earlier. Just what is the break-even units, what is the break-even dollars, and then understanding the graph, the right-hand side, the more it goes up, the more shaded areas in green captures the operating income. Okay, let's kind of combine all the ratios, the formulas we just talked about earlier. From the information of ABC companies here, you have number of units being produced, and the sales price, the number of units that's being sold, sales price per unit, the variable cost per unit, fixed cost for ABC companies, and the target operating income. Okay, so try to calculate, first of all, at least the first 4. We can go over target operating income a little bit later, but if you can, try to also figure this out. First 4, calculate contribution margin for every unit the company is selling. Then the ratio, relationship with sales, break-even point in units, break-even point in sales. Just list each and every one of them in the bottom of ABC companies, yes. So for every company, you will have 5 numbers. Okay? Yes, for each company you should have 5 numbers. Okay? So the target operating income is only useful for this. All right? Just try to do the ones as much as you can, and we'll go over it all together. Okay, let's take a look at company A. So we have sales price $100 per unit, variable cost 40, contribution margin per unit would be 60, right? 100 minus variable cost to give us 60 per unit. This is contribution margin for a company. And then the ratio we will calculate it by what? 60 over sales, which is 100, will give you 60%, right? So 60% means per dollar of sales revenue generated from selling these units, you're getting 0.6, 60 cents of contribution margin in order to cover fixed cost. So having that concept, then what is the break-even in units? So we have $72,000, and that $180,000 will leave it till target operating income. Because remember, break-even point, we're using 0. So the goal for a break-even in units will be using 0. So that target 180,000, that will be useful for the last one. Okay? So, but still, we need to cover fixed costs, so use this divided by 60, contribution margin. So you should be able to get 1,200, yes. So that's the break-even units, meaning company at least has to sell 120 units in order to not have loss. So we have this. What about break-even in sales dollars? 72,000 divided by 0.6, so this 1,200 units will turn into how many sales dollars? Will turn into 120,000, yes. Thank you. And then the last one, remember upper portion here, we're talking about break-even units, setting the operating income at 0. So for target operating income, the units that we need to achieve the $180,000 will be, again, using the ratios, fixed costs we need to cover, but now we're not adding 0, but we're adding that operating income, this target income. All these together divided by, we'll be dividing it by 60 because now we're trying to get the units. Okay? If the problem asks you what is the target sales revenue, then you'll be using contribution margin ratio. If it's units, divided by every unit's contribution margin. So how many units do we need? 4,200. Yes, 4,200. Okay, this is company A. Now B follows the same process. So we have revenue, how much for each? 40, and variable cost 10. Every units we sell, we're able to get contribution margin 30. 30 divided by sales price, which is 40, give you 0.75. That's the ratio, or 75%. Break-even point in units, what's the fixed cost? 60,000 for this company, and then in units, so we divide it by $30, which will give us 2,000 units. Okay, now break-even point in sales, again, fixed dollar amount, but divided by 0.75. How much is this? It's, yes, 80,000. And then the last question, target operating income. So we still have fixed costs. For now, we're not calculating break-even. We're calculating operating income, then divided by 30. So the last one here should be able to get 4,500. Is that correct? Okay, now for C, same thing, 125 minus 100 should be able to get contribution margin 25 per unit. It's 25 over sales revenue, which is 125. This ratio is 20%, right? Now, break-even point in units, fixed costs for this problem, 40,000, then divided by 25. So this one here, 1,600. And break-even point in sales, again, we need to calculate fixed costs divided by 20%. will give you 200,000. Last one, target income 100,000. Again, you have fixed costs to cover, and then 100,000. Okay, so these are different companies with information on sales, variable costs, fixed costs. You should be able to get what's the minimum units they need to get in order to not have loss, what's the minimum sales revenue they need to get. And then if a problem gives you, they have a plan, the target profit for next season, how much sales they need to get in order to meet that target. You mean from here? We would say the more contribution margin the company is able to get, the more the company is able, yes, later on. Because this company is able to generate for every sales dollar is 0.75. So for the same dollar of sales revenue, they're getting more, right? So which makes this ratio very important because the wider contribution margin is, the more they're able to generate profit quicker. Okay, any questions on this example, exercise? No. Let me just briefly go over the next part. Really, it's just linking to the same concept here. It's just adding in a few more ideas. What if we change fixed cost? What if we change variable cost? How would this affect break-even point and then the profit that the company is getting? So earlier we really just talked about two topics, break-even points, and then what if we have target profit? But now what if we want to change the selling price? Remember earlier we talked about every event $200 and variable cost is $80 per event. Fixed cost is $12,000. That was the setting for the textbook problem. And what if we want to change this, or change variable costs, or change fixed costs? How would we have to calculate what it will be the new break-even point in units, or the new break-even in sales? Okay, so this is these few questions we call a sensitivity analysis. We're just using the same information, but we're rearranging the equation a little bit, plugging in new numbers. If the company later on decides to expand the business, to purchase in perhaps more fixed assets, they may have more fixed cost incurred, or to hire more people, they may also have other variable costs incurred, part-time workers, for example. How would this affect break-even units? How would they be able to raise the price or decrease the price to meet their new targets, new profit targets? Okay, so same example here. Let's say we have variable costs remains the same, 80. Fixed cost remains the same. But for each and every unit, we only sell it by $180 now. Okay, let's say the economy is not doing good and the profit, we're not meeting enough sales revenue as we plan to. And we decided to give customers some discounts, just selling the event $180. So then do we have an increased break-even sales in units or decrease? Meaning that if we lower down break-even, lower down sales revenue for each and every DJ services event we provide customers, how are we able to meet the zero income goal? We have to sell more in events, right? If earlier we provide to 10 customers, that will give us $2,000. Now we lower it down every event, we're only getting $180. We provide to 10 customers, we're not getting $2,000, we're only getting $1,800. So we need to sell more events. So you can see that the right-hand side raised to 120 events instead of 100 that we had earlier for this problem. Right? So meaning the new break-even sales will be, the break-even in units, break-even sales will be changed based on the new sales price. Because in order to make that equation, sales minus the total cost equals 0, If you change the sales portion, you lower the down per unit, you need to make more sales. You need to have more customers in order to break even. Okay, it's just that each and every customer, you're generating less contribution margin. Earlier, we had 120. What's the new contribution margin here? Only $100, right? Earlier, we had 200 minus 80. Now we only have 180 minus 80. So every customer, we're just generating contribution margin $100 for each and every event. So since we have a lower contribution margin, we need to increase the X part, the units that we're selling, in order to break even. So this is the first example, changing sales price. Other examples, let's say we want to change variable costs. We hired more people, we had more cost incurred, and these are costs that floats along with sales volumes. So if the variable costs switch from 80 to 120, what would happen for break-even events? It also goes up, right? Sales price goes down, break-even events will go up, we need more customers. If variable cost goes up, again, this lowers and shortens our contribution margin. Earlier we had 200 minus 80, now it's 200 minus 120. So for every customer, we're only generating $80 contribution margin, and we need more of that to cover the fixed cost, $12,000. Okay, so this is another example that will increase break-even units in order for us to actually cover the costs. So we're changing sales, or we may be changing variable costs. What about fixed costs? Same thing, right? If cost goes up, fixed cost $15,000, then we also need to have more customers to purchase. The X has to be increased in order to break even. Yes, so remember last week we covered a little bit the relevant range of cost. Fixed cost, if we use an equipment for, let's say, 10,000 hours, lower than that, fixed cost perhaps is just $100. But if we expand the business, now we have a lot more customers, then the fixed cost may jump to 200. But it's still the same within that range. Okay, so this is assuming that we expanded the business, bump into the second range. That will still stay the same within that relevant range. Okay. Now, just a comparison of these different costs that we mentioned. If it changes, how it affects the two columns. So the first line, sales price per unit. If we increase sales price, so as opposed to the example that we just talked about earlier, if we decrease it, if we increase sales price, the effect to our contribution margin, assuming that everything else is the same, we just increase sales price, then we have a higher contribution margin, right? Because contribution margin is the difference between price and variable costs. So if we increase sales price, everything else the same, we have a higher contribution margin, and this will result in a lower break-even units. If we increase sales price, everything else the same, we just need perhaps 90 events in order to cover all the costs. So as opposed to that, if we decrease sales price from 200 to 180, contribution margin will also be decreased. Everything else the same, and then we need more units to break even. Okay, so this is sales price. Variable cost per unit. Variable cost, if it increases from $80 to 120, this lowers down the contribution margin, and again, the break-even units has to be increased. As opposed to that, variable cost, if we decrease variable cost from 80 to 40, everything else stays the same, then the contribution margin widens, and we will just need a few units to break even. So you have to understand the relationship in this equation, how it affects contribution margin, how it affects break-even point. Now the last category should be simpler, fixed cost, because fixed cost doesn't relate to contribution margin. Contribution margin is just the relationship between price and variable cost, so it doesn't change contribution margin, regardless if fixed cost goes up, bump into the second range or third range. But it still affects at the end the units you need to sell in order to break even, because it's still in the equation. Remember, we minus variable cost, then we minus fixed cost. So if this portion goes up, we will still need an increased units to break even. Fixed cost goes down, then of course we will need lower customers number to break even.
or lower sales in units.